Good afternoon, everybody. Thank you for joining us in our bonding and government contracting workshop. My name is Lily Keeve. I'm the project director of Northwest Small Business Transportation Resource Center, a mouthful name. We are a technical assistance provider. We are funded by U.S. Department of Transportation, Office of Small and Disadvantaged Business Utilization, and Economic Alliance, Snohomish County. We help transportation companies or companies who wants to do business with U.S. DOT funding recipients, agencies like WSDOT, Sound Transit, even like local cities, airport, anybody that receive even $1 of U.S. DOT funding, we provide free technical assistance to the companies. And our goal is to help the firms to be successful to bid on U.S. DOT funding projects. And we provide free technical assistance, financial assistance, bonding assistance, workshops, seminars. We also have additional funding for companies who will work with our bonding producer to get bonded. So we provide the companies with free accounting service, legal service, anything that related to the work that helps the company to get bonding. And we cover 5 states. That's another thing that, if you want to apply any certification in Montana, Oregon, Idaho. Of course, we cover Washington and Alaska. And just special thank you for the partnership with PTAC, with PTAC Group, particularly with Leslie Miller. She's a rock star. And this workshop happened because of Leslie. And just want to, and also Colleen with ADC Clallam. So just want to say that this workshop is not just you go to the class and learn something, you meet with the expert and network. We want you to work with us after the workshop is done and take advantage of the program. It's free. I mean, we get credit. You get contracts, we get credit. So thank you so much. And I want to say a special thank you for Jessica Cheng. So Jessica, you could say hi so people knows when you start pestering them with the email. So without further ado, I would like to pass on to Tiffany Scruggs with Procurement Technical Assistance Center. She's a program manager. Tiffany, take it away.
Yeah, thanks, Lily, and welcome everyone who was able to hop on the line today. I'm Tiffany Scruggs and I manage the PTAC, Procurement Technical Assistance Center, and I work with Leslie Miller, who some of you may have already met through her outreach to getting you here today. I want to thank everybody that Lily thanked as well. Here in the Northwest, we are good partners. We like to leverage each other's resources and with one common goal, and that is to help businesses be successful. We want to see more businesses in Washington winning contracts in Washington state. And the Washington PTAC works well with businesses to provide one-on-one assistance on how to bid, how to find opportunities, how to market to government agencies or primes, how to get paid on a contract you already won, and anything else in between. So please reach out to us and see how we can support you in your business growth efforts. Our services are also free. We're funded by the government to provide this service. So take full advantage of it and please let us know how we can help you. And I'll turn it over to Colleen, one of my very favorite people on the Olympic Peninsula, who called me, a year or two ago and said, hey, I need more resources out here. What can you do for me? And we were able to drum up a little bit of support in the form of Leslie Miller. And then she said, what we need is more training and classes. So Colleen, take it away. And thanks for coming to everybody here.
So thank you very much, Tiffany. I am Colleen McAleer with the Clallam County Economic Development Council. We support businesses across Clallam County. And I recognized some time ago that our businesses in our county were not engaging in the government contracts, not just federal, but also state, but mostly local government. And so as a port commissioner, I saw that over a 6-year period, it's such a small percentage of those total projects, and I'm not talking just the primes for those projects, but the subcontractors, such a small percentage were going to Clallam County businesses. And that really frustrated me because I know it's the biggest area of leakage and we're an economically distressed county and we've got so many businesses that really struggle. So I so appreciate Tiffany and Lily and Leslie. As of late, Leslie has been, you know, kind of right-hand person in this space, and she has done so much work and helped companies. I just wish we had her for longer so we could really get into that whole process of weeding out those companies and sharing with them. This is a complex process. And so I feel like we're just getting going, and I'm so appreciative of all the support. And I'm hoping over the next years, we really are able to make a big impact so that our local companies are participating in this incredibly lucrative space. So thank you very much for doing this. And I hope this is of value to everyone, and I'll be listening in as well.
So thank you, Colleen, for your introduction. And I think we're about ready to go. We're going to turn this over to Mr. Terry Homburg of Washington PTAC. He is a retired contracting officer and is a wealth of knowledge. And he reached out to me when he heard about this workshop and said, well, I think we need to kind of talk about this stuff. So here we are. And with no further ado, I'll turn this over to Terry, and we'll all learn a thing or two about the Longshoreman Act. Thank you.
Thank you, Leslie. How much time do I have?
15 minutes.
15? Okay. So as Leslie said, I'm a retired contracting officer as of 2 years ago. I did 29 years as a contracting officer with the Department of Defense, and all of that time with the United States Navy. So I'm quite familiar with the Longshore and Harbor Workers' Compensation Act. When I heard about this classes on construction, and it talked about bonding and insurance, most of you know that there's an insurance requirement for liability for working on a government installation. What a lot of people don't know, including agency contracting officers, is the requirement for Longshore and Harbor Workers' Compensation Act insurance to protect you from bankruptcy. So this is my condensed version of this class to fit into this 15 minutes. I will be offering another class, probably an hour, hour and a half, full length, going into details. If you're interested, you can go onto the Washington PTAC website and find that class offering and register for that. So our goal for this session is for you to become aware of the Act, the impact on you, and where to turn to seek assistance. You can stay on, you can stay on that slide. As many of you know, like I said, liability insurance is a requirement for working on installation, but many of you may know little or nothing about this act and the insurance to protect you from bankruptcy. But as I also said, many federal agencies, contracting officers know little to nothing about this act also. So after this class, you can bring it to their attention because you'll probably know more about it than them. So I worked for 2 years in the Puget Sound Naval Shipyard, 2005, 2006, and every week I had to make determinations of whether a job was subject to the act or not. I worked 4.5 years out of the submarine base out at Silverdale, and same thing applied there because we have submarines there. So what I'd like you to do, instead of having answering questions during this presentation, if you can jot down your questions, we'll do it at the end because I have a very short time. These slides will also be available for you to get for future reference. And one of the last slides will be a great slide for you to reference in the future because it provides a phone number. So let's get started down this road of enlightenment. So there's the agenda. We're going to talk about a little bit about the background, insurance requirements, impact on you, when is it applicable, and who to contact for help, and then we'll have questions and answers. So the background, the act was passed by Congress in 1927. It was expanded via 2 amendments in 1972 and 84. One of those amendments added the information about situs and status. Situs is where's the work being performed. So it needs to be on a navigable waterway, such as Puget Sound Naval Shipyard, the Coast Guard Station at Port Angeles. Status is what's the nature of the work that you're doing. So you gotta be on navigable waterways for situs, and it also depends on the kind of work that you're doing, such as a production facility for repair of vessels, for example. The Act provides for compensation, medical treatment, and vocational rehabilitation. Next slide. Insurance requirements. The Act covers employees in traditional maritime occupations, such as longshore workers, ship repair, harbor construction workers. It does not cover the crews of vessels. That is covered under the Jones Act. It also covers non-maritime workers that are not covered by the state workmen's compensation benefits, that perform work, and this is important, on, over, under, and next to navigable waterways. Some examples in the state of Washington are the Strait of Juan de Fuca, Puget Sound, Lake Washington, Columbia River, Chehalis River. And for the Western United States, it also includes work inland that supports vessels on navigable waterways. Earlier last week, I did a check to see how many navigable waterways we have in the state of Washington. I was very surprised. There's 103 navigable waterways in the state of Washington. And what I've done there for you on this slide is provided you the website so you can look them up. Other rivers and lakes, for example, are navigable waterways. Next slide. Impact on you. And we'll go back over the underlined words here. If the Act applies to you and you do not have insurance, and there is a claim due to an injury or loss of life, your company is liable to pay for that claim. And if the company has insufficient funds, then the principals of that company are personally liable. So let's go back through and look at this. Number of elements here. If the Act applies to you, if you do not have insurance for the Act, and if the individual who was injured submits a claim, or worst case, that individual dies while working and the family submits a claim, the settlement, the court rules in the favor of the claimant, and then the company has to pay for that. And quite often they run at about $1 million in a claim. And if the company runs out of funds, then the principals of the company are held liable. And they go after the pockets of the principals, like the president, and so on. Next page. Applicability. So here I provided some examples of when is the Act applicable, and when is the what are some examples of work where it is not applicable. So applicable: production buildings supporting vessels, the installation of utility systems which provide service to the vessel. So if you're on a, say, a naval installation, and this doesn't apply just to federal, this applies to state, county, and cities, and universities, and whatnot. If they're on navigable waterways, you've got a contract to do work, this Act applies. So if you're on an installation and it's you're installing a utility system that some part of it supports the ships that are tied up at a pier, the Act applies to those employees. The demolition of a facility which is replaced by a production facility. So it's demolition followed by construction of a new facility. That work is applicable to the Act. So the following is some examples of work that is not applicable to the Act, or the Act doesn't cover it. Administrative buildings, facilities providing retail services like McDonald's, BEQs and family housing, garages and parking lots. And this is next one is similar to the one above, but there's a little nuance to it. Repairs to utility systems, even if they provide service to a vessel. So the first one was installation of new. This one is repairs to that utility system, not covered by the Act. Facilities for union spaces, demolition of facilities that is not replaced. So there's the nuance from the one up above. The one up above is demolition when it's going to be replaced with a new building. This is demolition that is not replaced with a building. Delivery drivers and aquaculture. So those are just some of the types of work that are not applicable to the Act. Next page, continuing on. The Act is not interpreted the same everywhere in the United States. The West Coast, for example, is different than the Gulf Coast and the East Coast. The West Coast courts have broadened or widened the interpretation of the Act. So on the West Coast, inland facilities are covered by the Act. Here's a couple of examples. So if a production building in Sandpoint, Idaho, which is where the Navy has a facility, repairs vessel components for ships that are located at Puget Sound Naval Shipyard, then those workers may be covered by the Act. Second example, a production building on the upper base, Bangor, Washington, supports the ships or the boats, submarines, tied up at a pier on Hood Canal, then the workers may be covered by the Act. So when I worked out at submarine base, Silverdale, Washington, in the Public Works Department, when we had contracts for the shops that are supporting the ships down, or the boats tied up down at the Delta Pier, that work that was done in the shop in the upper base was subject to the Act because it provided, it supported work on the submarines that were tied up on a navigable waterway. So the West Coast, anywhere on the West Coast, the courts have a broader interpretation of the Act. So it's not just over, on, under, or next to a navigable waterway, but it can be inland also. If the inland facility is supporting that vessel on the navigable waterway, it is also covered by the Act. Down on the Gulf Coast, Texas, Mississippi, whatever, that is not the case. You have to be on, over, under, or next to the waterway, not inland. Same thing on the East Coast. Next, this is a very important slide, and you'll probably want to be referring to this in the future. Who to contact when you have questions. So when in doubt on coverage of the Act, you can call the Department of Labor. The Seattle office is our closest one. There I am providing you the phone number. They can also refer you to types of insurance, and there are different categories of insurance. Some of them are called nuisance policies. This is where just a small portion of your workforce may be subject to the Act, and you just need to get a nuisance policy to cover you. Washington also has an assigned risk plan. There's also another organization called Safe Shore for smaller policies, and there's also American Equity. But that office, the Department of Labor in Seattle, can refer you to those. They can also, you give them a description, and it's all done by phone. You can give them a description of the nature of the work, the number of employees and whatnot, and they can tell you whether they are subject to the Act or not. And if they're not, then it probably is going to come under the Washington State L&I. So I've also identified where the West Coast offices are located. They're in Seattle, San Francisco, and Honolulu. The current director, and I worked with the previous director also, shares his time at all 3 locations. So he is flying quite a bit, and he has staff in each of the offices. So when you call that number, the 206 number in Seattle, there are people there to answer it, even if he is not there, and they can answer your questions. There's about 3 people in the Seattle office. Okay, so I have some time left. I'm on my next slide, which is time for questions, and then we'll go on to a summary after that. So we'll take questions now. How am I doing for time? Okay, got it.
I'm a money, Terry.
Okay, very good. It's the first time presenting this condensed, but I think it is so important because I have worked with this act for many years, and even the contract specialists and contracting officers that I worked with knew nothing about it. And I got the director out of Seattle to come my year before I retired in 2007 and gave a presentation on the act to all of the acquisition people around Puget Sound. We opened it up to the Navy, the Army, the Air Force, the Coast Guard, contract specialists, just so they can become aware of this. Especially when contractors submit a cost proposal and there's a line item on there for insurance for this act. It is allowable and it is needed. While I was a contracting officer, I did see a company who did not have the insurance, got a claim, and they went bankrupt because of it. It puts companies out of business. This is really serious stuff. Questions?
Yes, my name is Angelica Duncan. I work with a small asphalt construction company in Edgewood, Washington. And we are a women-owned business. We are SBA, DBE, all of that. Now, oftentimes we are hired by a prime contractor to do asphalt construction. And if it's a big job, like a prevailing wage, government or state job, we usually ask them to cover the cost of any additional insurance or bonds that might be needed for us to participate in the project. Is there any information you might have regarding that? And maybe there's something we don't know about, or what if a prime contractor is like, sorry, no, we're not going to pay for that additional cost for you. I'm just curious to learn more.
Yeah, so and that's a common recurring question that comes up in a lot of training sessions. So if the prime contractor is not willing to have the coverage for the subcontractors, then the subcontractors need to get it. You don't want to be caught with your pants down, so to speak, and not have the coverage and have one of your employees who is covered by the act get injured or worst case die. Mm-hmm. Chances are you're going to go out of business. Now, mm-hmm. Keep in mind, there are lots of exceptions to the act as I went through some of them. So one of them is, or two of them is, or one is parking lots, roads. They're not subject to the act. So that's covered under state of Washington, Illinois.
Okay.
So I heard you say you're in the asphalt business. So typically you're doing roads,
yeah,
and parking lots. You're not subject to the act.
Okay.
So you're going to be covered by the state of Washington, Illinois. That's a great question. It keeps coming
Thank
up.
you. Thank you for your knowledge on this. Thank you.
You're welcome. Another question. It can be a scary subject, and unfortunately, a lot of companies and agency contracting officers are unaware of the act. The worst case scenario is you're a company, you're construction, and you're doing some work on a pier, for example, and your employees are covered by the act because they're working over water on a navigable waterway. And so there is an injury or worst case death, but let's talk about an injury. And so the person or the company files a claim to the state of Washington. The state of Washington is notorious. They will deny a claim in a heartbeat, right or wrong. And in this case, they would be right because it was work on a navigable waterway, which is covered under the Longshore Harbor Workers and Compensation Act. And if you didn't have an insurance policy for it, then you're going to be liquidating assets to pay for that claim. And those claims can be hundreds of thousands of dollars. We're talking about medical treatment, vocational rehabilitation, and so on. And it can get expensive. It could be long-term. It could be for that person's rest of their life. You need the insurance. Now, when I worked working with government estimators, I would tell them to put in their government estimate for a line item just for this insurance. This insurance can run anywhere from 18 to 27% of your labor effort. So typically when you're putting a proposal together, you got labor, materials, and equipment. So this is insurance against your labor. And it's not all labor, it's only those people who are subject to the act. So that's another part of it also. So when in doubt, call that phone number, the Seattle office, and they can help you through that. A lot of insurance companies do not sell insurance in this. You have to normally go to another insurance company to get this. And the Department of Labor in the Seattle office can help you with that too. Any more questions?
Yeah, I have a question. My name is Trisha Lewis and my company is Pacific Rim Environmental. We do consulting services. So we're a professional service. Does that fall under this? So like right now we have a job at the shipyard, but we're not on a ship and we're doing professional service. Are we supposed to be covering this? Is that covered under this app or is that covered under LNI?
So are you doing like studies and surveys and engineering, coming up with drawings for the prime contractor or the government?
No, we're doing testing for regulated building materials and other hazardous materials.
So do you have any number of your people going out onto the piers and the docks to do sampling and whatnot?
I don't think the work is being done on a dock at this point. I think it's in the infrastructure inside the facilities. So.
But they're doing work in support of the vessel. That would be a case where I would want you to call that 206 number in the Seattle office and ask them if any number of those employees are subject to the act.
Okay, perfect. That's what I was wondering. Thank you.
Okay. Anybody else?
Well, thank you, Terry. That was really an eye-opening little session you have there. And again, if you want more information, Terry will do an expanded version of this presentation down the road through washingtonptac.org. So moving on to our next speaker, we have Ms. Kara Skinner from Integrity Surety Bonding, and she's going to talk a little bit about what you need, what you don't need, and moving forward. So with that, Kara, you're up.
Thank you. I appreciate the introduction and thank you for having me, letting me talk about surety bonds. Thank you guys for all joining us. Am I allowed to share my screen, Jessica?
Yes, you have the power now. Thank you.
I have power. Okay. Here is the power. Let's make it look like a real PowerPoint. There we go. All right, my name is Kara Skinner. I'm from Integrity Surety. We're a wholesaler. I'm going to explain a little bit about what that means later on. I am a third generation surety bond producer. My father was in the business, his father was in the business, and I'm not going to tell you the whole story here. If you want to read about it, if you go to thebonder.com, there's a little write-up of me, which is not as interesting as how my father and grandfather got into the business. So you can go to bonder.com to get that. My background. I also wanted to mention, I didn't put this on there, but Lily and Jessica know, I did write a Little Black Bond book. I don't know if you can see that there, Little Black Bond book. This is pretty introductory, but it's what my intent behind this is a reference guide. So maybe not something you would read cover to cover, but a reference guide for surety bonds for contractors. And if you go to the littleblackbondbook.com, you can download this for free for now. If you want a hard copy, let me or Jessica or Lily know, and we can be sure to get that to you.
Yeah, let's just email us. We will be happy to send you the hard copy. We'll take care of it. Thank you.
Or the link to download a free copy. You can let Lily or Jessica know. And I think Jessica made up or helped me put together some poll questions. Do you have that first poll question ready, Jessica?
Yes, I do.
Do you want to pop that up? I don't know if I'm going to see it. Oh, there it is. Okay, so basically what I'm looking for here is how well do you know surety bonds? And if you don't mind participating, this is mostly anonymous. We could probably, if you were techie, you could probably figure out who's who, but for now, this is just anonymous.
So Kara and everybody, the poll is anonymous, so we do not know who answered what and what your answer is. So feel free to answer.
I don't want to wait too long, but the question is, how well do you know surety? I'm looking for basically where you're at and how well you know surety. And it looks like, I think we can see the poll results there, that we're all pretty new, which is great. That makes my job really fun, actually. So let's move on to the next slide and talk about, can I X out of that? Oh, there we go. There we go. So what is surety? When I was a little girl, my father used to say that surety is the opposite of insurance, which is actually a little confusing because most of you probably go to your insurance agent to purchase this product, right? So if it's opposite of insurance, what the heck is it? It is assurance. It's a credit relationship. It's a financial product. So when you apply for a surety bond, and if you've only applied so far for your license bond, it was probably pretty painless. You probably just had to submit your name, address, and social security number. They run your credit. Imagine applying for a credit card, right? Name, address, social security number, they run your credit, and then you get approved for a certain amount of credit on a credit card. And that's how surety bonds, when they're small, will work. Oh, let me just say too, if you guys want to unmute yourself, if you want to interrupt, I really want everybody to hopefully walk away with at least one thing you didn't know about surety before I started this class. So feel free to interrupt me, feel free to raise your hand. I might not see it, but I think Jessica and Lily are going to be on top of that, and that can help you. And maybe both Lily and Jessica, if you see some questions in there, feel free to interrupt me as well.
Absolutely. Thank you, Kara.
Thank you. Okay, so let's start with, who are the parties to a surety bond? Who are the principal entities of a surety bond? And I don't know, depending on how big your screens are, you might not be able to see all of this, but the three parties to a surety bond are the principal, the obligee, and the surety company. In the middle there, you'll see they all overlap. They're all part of the bond, right? In the middle is the bond. The principal is probably going to be you, the contractor. The obligee is who you have a contract with. So again, this is a little tiny here. In between principal and obligee there, you'll see the word contract. So you contract with the city, the state, the county, and that contract is between you and the obligee, and we are bonding, and this is important, we are bonding whatever is in that contract. So the bond is literally only a couple of pages, if that, and it is attached to the contract. So there isn't a lot of wording. It's not like reading an insurance policy, if you've ever done that, which I have not. Many, many pages, lots of exclusions. The bond is basically one page, says who the parties are, the principal, the obligee, the surety company, and we're guaranteeing whatever's in that contract. So that contract is really important, not just for you to read and understand, but also for the surety company to read and understand. And a benefit to you as a principal or contractor is that you have the experience of a surety company behind you taking a look at that contract with you. So principal is you, the obligee is who you have the contract with, and the surety company is typically an insurance company, which again just confuses things a little bit, but the surety company, I like to think of them, if we're using the analogy we used before for credit, imagine the surety company kind of like a bank. And when you apply for surety, it's going to feel like you're applying for a bank loan. There's a lot of similarities there because, again, this is a financial product. All right. Since you are going to an insurance agent, we are regulated by the insurance commissioner. I thought it would be only fair to point out the differences between surety and insurance. And I'm going to probably say this more than once. I'm going to say typically or normally, because as you know, and especially as contractors, there is an exception to every single rule. In surety, it's typically a 3-party agreement. Sometimes it's more, but it's always a minimum of 3 parties. For insurance, when you purchase insurance, it is typically, traditionally, a 2-party agreement. When you buy insurance, you're the insured, and then you have the insurance company, and it protects you on the insurance side. On the surety bond, you are not protected. And I think this is probably the biggest distinction between surety bonds and insurance. You as the principal are never the beneficiary of the bond as the principal. You benefit because you have the privilege of entering into a contract, but you aren't the beneficiary and you can't make a claim on the bond. The obligee, the city or the county or whoever you have your contract with, they are the beneficiary of that bond. Usually surety bonds are project specific, usually insurance is term specific, right? From one date to one date, it's usually 1 year. To reinforce what I said earlier about surety bonds protecting the obligee, your city, the county, whoever you have the contract with, is the one who can make a claim on your bond. You cannot make a claim on your bond. You don't want to make a claim on your bond. You don't want claims on your bond, period. For insurance, though, when you have a claim, if something goes wrong, you do make a claim and you are indemnified. You're made whole on the insurance side. In insurance, I think it's important to note too that losses are anticipated. You know, we come together for insurance so that we're sharing that risk, right? On the surety side, the way the surety underwrites, they underwrite to no losses anticipated. That just means that the surety company hopefully is underwriting so that you, contractor principal, you don't lose. I never want to write a bond that puts you out of business because it could, and I will explain a little bit about how that works later on. One of the things I did not put on here that is actually similar for surety and insurance is that it is a transfer of risk. So either way, either product is in some form transferring risk from one party to another. When you buy insurance, right, for auto or home, you're transferring the risk from you to the insurance company. On surety, it's the obligee who you have a contract with. They're the ones transferring the risk from them to a third party, which is the surety company. All right, the life of a bond. I thought this would be kind of nice to get a visual of where it starts and where it ends, that kind of thing. So we've got a little circle of life here for the bond. So it starts with the obligee. We know who the obligee is, right? They're the beneficiary. It can be the federal government, a city or a county. It could even be a private job. It's unusual, but we do see some bonds to private entities. Another thing I should point out here that's not written is that if you are a subcontractor and you need to post a bond for a project on that subcontract, the obligee is the general contractor because it's whoever you have the contract with, and your contract is with the general contractor. So in that case, you're the principal subcontractor. The obligee is the general contractor. So the obligee comes to you and says, hey, you need to sign this contract. We want you to do this work. And you need to provide a bond. You're the one, as a principal of the contractor, ultimately responsible for completing the contract. You could be a corporation, individual, partnership. And I'd like to reinforce that you as a contractor, the principal, are partnering. You team with the surety company. You guys are on the same side. It doesn't always feel like that when you're working with insurance companies, but in this case, especially in surety, we're all on the same side. So you go to the insurance, you go to your insurance agent, right? And you say, hey, I need a bond. And then the insurance agent or our office will go to the actual surety company. So this is Remember our analogy earlier was that they're like a bank. They're the money, right? So they're the ones that ultimately will bless the bond and approve the bond. They again join with the principal. They're a corporate surety. The surety companies we use are all corporate sureties. We represent about 50 of the top 100 surety companies. And they're all corporate surety companies. They're all US Treasury listed. I'll explain that in a minute. They're all AM Best rated, either A or better, which is something that you want and you do care about. I do want to just mention the words individual surety, because there is such a thing as an individual surety company. You'll see some wording on the federal bond forms indicating that is such a thing. I don't recommend it. And I'm usually totally out of the picture, obviously, when there is an individual surety, but there is such a thing. And I just want you to have heard the word before and know that there is such a thing as that. So the surety company then issues your bonds, contract or commercial, and we'll go over what those two things mean in just a little bit. So they issue the bonds, and then what? So now we've issued the bonds. Do you have a chance, Jessica, to put up the next poll, the now what poll?
Coming right up.
Okay, awesome. So what happens to the bond after it's been issued? Do you file it in a locked drawer? Do you send it to the surety company, or do you send it to the obligee? I hear somebody's dog barking. I was going to say earlier, I think it's kind of fun to have some Zoom calls. If we don't hear a dog bark or a cat walk through, it is not a proper Zoom call, right? All right. Oh, you guys are awesome. This is great. Okay, I don't think I can press the next slide. But so it looks like send it to the obligee is what everybody has agreed to. And that is absolutely true. That's awesome. You guys did a great job. Yay. Life of a bond starts with the obligee, ends with the obligee.
Kara, we do have a question from one of the participants. So the question is, what is the difference between a bid or a payment bond versus a bid bond?
Okay, I actually have a slide on that. Do you mind waiting just a couple of minutes and I'll get to that?
Sure, thank you.
Okay, thanks for the question. Do I have until 1:20 still? I just want to make sure I'm going to stay. Okay.
Yes.
All right. So we'll go through this a little bit quickly. I think this is really interesting. To me, this is probably the most interesting part of the presentation, and it reinforces some of the things that I was saying earlier. First, the history of surety. Surety has been around. The concept of surety, not in its current form. The concept of surety has been around for a really long time, literally thousands of years. In 1894, the Hurd Act was passed. The Hurd Act said that any federal funds that go to a contractor over a certain threshold need to have a guarantee, a surety, to guarantee that they're going to complete the work. And this was to protect, and still is, to protect our tax dollars. In 1935, the Miller Act replaced the Hurd Act. The Miller Act is still something that we talk about and we still hear to this day. The Miller Act replaced the Hurd Act and added on the payment guarantee. And I will go over the difference between bid, performance, and payment in just a little bit. But in 1935, the federal government went to the banks and said, hey, banks, this is a financial product we need you to provide to contractors so that we have some guarantee that they're going to complete the work. And I don't know if anybody, well, hopefully nobody was around in 1935, probably not. In 1935, when the federal government went to the banks were struggling. If anybody remembers their history, we were having some problems with the banks in the 1930s, and the banks said, no way, we're not doing it. But the insurance companies at the time had money, and they stepped up and they were like, here we are, we will help you provide this guarantee. So it is only actually in the United States, Canada, and Mexico that these guarantees, these surety bonds, are provided by insurance companies. Most of the time in the rest of the world, overseas, in Europe and in Asia, these bonds are provided by banks because this is a financial product. I added the words Little Miller Act. Little Miller Act is for states. When states adopt a federal act, they will reword it and make it a little act. So the Little Miller Act is for the states. Okay, we're actually going to go into more detail, but I wanted you to see the major categories of bonds. We have contract bonds and we have commercial bonds. In contract bonds, which is where we're going to stick to most of the time for this class, are the bid, performance, and payment bonds. And I will go into more detail on that. The commercial bonds are things like your license bond, right? Your contractor license bond. If you've ever needed a court and probate bond, that would fit in there. They are mostly financial guarantee kind of bonds, which means that they're guaranteeing that you're going to pay something. Okay, so contract bonds. We're going to start with bid bonds because that's typically where you start as a contractor, right? You're bidding a job first. So you're looking at the contract specs or the invitation, and it says that you need to provide a bond. The bid bond is typically a small percentage, 5 or 10%, 20% if it's federal. A small percentage of your estimate. The bid bond guarantees that if you are the low successful bidder, that you will enter into a contract and supply the performance and payment bonds, which come next. This is why at the bid bond section, when you're first applying for it, the surety company will be underwriting you as a principal based on the full contract price, not just the small 5 or 10% of the bid bond. This bond typically doesn't cost anything. The bid bond doesn't cost anything. And that's because you're not making anything, right? But at this point, and I think somebody had asked a question earlier about making sure you add in certain costs. At this point, this is when you want to make sure you've added in the premium for the next 2 bonds, and I'll explain those in a second, for the next 2 bonds that are coming, the performance and the payment bond. Because the cost, the premium for the performance and payment bond should not come out of your pocket. It should be paid for, because remember, they're the beneficiary, the obligee, right? It should be coming out of their pocket. They should be paying for this. So at this point, the bid point, if there isn't a space for a line item for the insurance or the bond, somehow get it into your bid. And I know you guys can be creative and get it in there somehow. So let's say you've bid the job, you've posted your bid bond, and now you have a contract, you're the low successful bidder, you either have a contract or letter of award or letter of intent to award. We start looking at this stuff, and at that point we start underwriting the performance and payment bond. For the most part, you're probably already qualified because of the bid bond, but we'll take a closer look at that contract for you and let you know if we see anything weird or onerous in there. The performance bond guarantees that you are going to perform whatever that contract says. The payment bond guarantees that you are going to pay your sub-suppliers and material people. And the reason for the separation, and really in the surety underwriter's eyes, and for the surety company, these bonds, the performance and payment bond, are basically one guarantee. They underwrite it together. They don't underwrite it as separate bonds. They charge for it together as one. So typically, let's say if you're just starting out, the rate for a performance and payment bond might be somewhere in the neighborhood of 3%. So it would be 3% of your contract price, and that would cover the cost of both the performance and the payment bond. So the payment bond guarantees that you're going to pay sub-suppliers and material people. And the reason for the Miller Act adding this on is because typically you cannot lien a public works job. So the federal government at the time wanted to make sure that the sub-suppliers and material people were going to be paid with our tax dollars ultimately. Does this help answer the question that you had earlier about the difference between the performance and payment and bid bonds? I don't remember who that was. If it hasn't, interrupt me, let me know, and I'll go on. There are 2 other bonds I wanted to mention. I don't want to spend a lot of time on these. There's maintenance bonds and retainage bonds. You probably won't run across maintenance bonds very often. Usually your contract, especially public works contracts, will include a maintenance period, right? Usually workmanship maintenance or warranty, you're warrantying your work, your workmanship, is 1 year, typically in most contracts. So if that is in the contract and you have provided a performance bond, you're already guaranteeing the maintenance or the warranty period in your contract. So rarely will you see a separate piece of paper to issue a maintenance bond. Every once in a while, you might see that. Another item here is retainage bonds, and I could probably go on a little too long on retainage bonds. Most contracts have a retainage or a holdback. The owner, the obligee, will hold back 5 or 10% of your contract funds throughout the project. Once you're complete with the project, they will return those funds to you as long as you have completed the job successfully. There is a bond to get those retainage funds early, either distributed throughout the whole contract or at the end of the job. Usually these bonds are issued for large, well-established accounts. Sometimes we can do them for smaller, newer companies, but usually you have to have a facility already set up with the surety company. All right. Any questions so far on different kinds of bonds? We're going to go into underwriting a little bit. This might be a little dry, so I'm going to try and make it as interesting as I can. So remember earlier on, I said that underwriting or applying for a surety bond is going to feel like you're applying for a loan at the bank. This is what I'm talking about here. You're going to have an application or a questionnaire. If you are, and because you guys are relatively either new to surety and maybe even new in business, some of the things that are going to be important for you, because we're not going to have a whole lot of history, or you're not going to have a whole lot of history within that application or questionnaire, an org chart, or down below you'll see resumes, references, business plan. That's going to be especially important. And I know, and I hope I'm not speaking out of turn, Lily and Jessica, that they have some resources for you to help you with the resumes and the business plan, as well as some of the other things on this list. Another thing we're going to need that's important are financial statements. The surety company likes to see 3 years of company financial statements. I'm going to go into what that actually means in just a little bit. They also want to see a personal financial statement. And again, if you're new-ish in business, the personal financial statement might mean a whole lot more than a company financial statement. Bond requests, always, of course, important. We want the details from your point of view. So we might be able to read the contract and see that, you know, you've got 6 months to complete a job, but we want to hear from you what your true estimated start, estimated completion time is going to be, because it might not fit in necessarily to that.
Sarah,
Yes.
Sorry to interrupt. There's another question. Is that okay, or should we wait?
No, of course.
So yeah, how does the work with Washington how does that work with Washington law to allow for a retention bond for subcontractors on public projects, public works project?
I'm just going to go back to this slide really quick. So for retainage bonds, it does get a little bit complicated. In the state of Washington, the general contractor can post a retainage bond, so the general contractor can be getting those funds throughout the job or get it early in some fashion. Your contract, if you're a subcontractor with that GC, you would post that retainage bond to the GC if they're also holding back retainage. And then you would be able to get those funds throughout the project or early in some fashion. The new thing here in Washington is that if a general contractor has posted it, they have to allow you to post it. And even if they haven't, they still have to allow you as a subcontractor to post that bond to them, but they may charge you for their portion of that retainage bond. So this is where it gets a little bit confusing. Let's say your retainage is going to be $50,000 on a particular project. The retainage for the GC is obviously going to be much larger, right? So maybe they don't post a bond, but you post a $50,000 bond to the general contractor. The general contractor then might charge you for a retainage bond that they have to post for that $50,000, because they don't want the general contractor doesn't want that coming out of their pockets, right? They don't want anything coming out of their pockets probably, but you may have to pay twice as much to get that retainage bond if you are a subcontractor. And it's something to think about. It's something that when we approve those bonds for our contractors, we make sure that they have checked with the GC so that before they purchase it, they at least have information or enough information to make an informed business decision before they go ahead and purchase that bond and then get a surprise bill from the GC. Does that answer that question? Yeah. Awesome question, guys. Okay, more underwriting. I will do the agent write-up. That's me. Basically, what I do here is I want to make your company look the very best it can look when I make a presentation to the surety company, and that's what we call it. It is a presentation to the surety company. We do not want to just throw a bunch of half written up things, partially done things to the surety company. Imagine the underwriters are sitting behind a desk. They're not out there seeing your work and seeing what you guys can do. So we have to give them the best visual we can. So I like to say that when I make a presentation, I like to put a nice big red bow on it so that when they look at it, it's easy to look at. They get all the information they need, and hopefully they don't have to come back with too many questions and comments, and they can just approve the bond. The last thing here are bank line or bank statements. I'm going to tell you that getting a bank line might not be that easy, but if you are already applying for surety credit, applying for a bank line is going to be a duplicate of almost everything we've done. So if you're applying for either a bank line or surety credit, I would suggest trying to do them both at the same time. And you might even say, I don't need a bank line right now, but this is the time when you don't need a bank line. This is the time to get it. Because imagine what your financial statements might look like when you do need a bank line. It's going to be a lot easier to get a bank line when you don't need it than to apply for a bank line when you do need it. And the surety companies, oh, yes, go ahead.
I'm so sorry.
No.
So you mentioned the importance of getting a bank line also, even when you're not needing it. Well, when we apply for a bank line, doesn't we get a ding on our credit report by applying for it?
Yes, you will. You won't get a ding on your credit report when we run your credit. Here's what I would suggest. If you don't have a relationship with your banker, develop a relationship with your banker, or find a banker that you can develop a relationship with. Hopefully they will have already run your credit, and hopefully they won't need to run it again. If you have to go to 12 different banks looking for a line of credit, I would say maybe getting a bank line is not, you're not ready just yet. But if you can go to the bank you already have a relationship with and they run your credit one time, it really shouldn't affect your credit all that much. And in fact, what will happen, hopefully, if they do run your credit and if there is a small ding on your credit, if they do give you credit, now that is going to be on your credit report. And now your credit report should go up unless you use the line right away. If you have available credit on your line of credit, it will actually raise your credit score more than running your credit, lowering your credit score.
So having a bank line really is advantageous when we're ready to get bonded.
Yes, well, and it's advantageous as a business owner. If you happen to get into a job that's a longer term or a larger job than usual, having a bank line as backup working capital could save you. If for some reason, if you're a subcontractor and your general is dragging their feet, which I'm sure never happens to any of you, but they don't pay you right away, and you need to pay your people, your employees, or subs or other supplies, it's nice to have that bank line as some buffer for you.
Kara, I think
Yes.
with the line of credit as well, it could help if, let's say, I'm a company who wants to increase my bonding capacity.
Mhm.
If I don't use my line of credit, that could be used as a working capital, right? So I mean,
Absolutely.
just as long as you don't use it. I mean, that's kind of like I mean,
well, I don't want to say don't use it. The surety company, of course, likes to see you have this line of credit that you never use. If you do use it, pay it back right away. So like I said, if the reason for the use of the bank line is because you didn't get paid right away, hopefully you get paid within a few weeks and you can pay that line right back. And don't try not to leave a huge open balance on your line long term. The idea is it's for emergencies.
yeah, 'cause I have a client I have a
Yes.
client who's actually need to increase their bonding capacity because of the project that they're bidding, but then they don't have enough working capital. So they use their line of credit, which actually triple their bonding capacity, which is actually great in my opinion. You know, I know
Yes.
that it's not your money, but you could be considered that as a working capital.
Absolutely. Absolutely. Because it ultimately is, you will end up with a liability, but it is working capital for you. And as long as you have a way to pay it back, you know that the money is coming in, especially if it's a public works job. There's a 99.9% chance you will be paid and you can pay it back. Sometimes when you're working with owners, they don't pay you on time, and this is really nice to have. Sometimes to start a job, right, you have to mow, and all of that costs a pretty penny, I'm sure, a good chunk of the project, and you're not being paid before you start the work, probably. Probably. Does that help answer your questions?
Yes, thank you.
Yes, of course. And actually, we did talk a little bit about this. There are credit reporting agencies. The surety company will run your personal credit, but it will not affect your credit score. What we call it in the insurance industry is a soft hit. So a soft hit on credit reports means that there's a record, like if you looked at your credit report, you would see that the surety company ran your credit, but it does not affect the credit score. Business credit report, there usually isn't much there if you're relatively new in business, but the surety company will run that, and I thought you should know about that. The Fair Credit Reporting Act is something I thought you should at least have heard the term. And basically this says that the credit reporting agency has to be fair, accurate, and keep your privacy. And one of the things with that privacy is that I might be able to run your credit, but I'm not allowed to tell anybody, including you, what is on your credit report. So even if I run your credit and there's something on there, I might just say, I need you to go get a copy of your credit report and take a look at it, because I am not legally allowed to tell you what's on your credit report. One of the things I also wanted to mention, I kind of alluded to earlier, is that on your credit report, because this is going to be, this literally is the first thing the surety company is going to do, is run your credit. And then everything will kind of hinge on what that credit report says, not just the score, but what the credit report says and what's on there. Because real humans are looking at this for the most part, especially when we're talking about a program. One of the algorithms, and of course the credit reporting agencies aren't going to tell us exactly what their algorithms are, but one of the algorithms that the credit reporting agencies use is how much credit you have available. So remember, like I said, if you get a line of credit and you're not using it, that is available credit to you. So the more available credit you have, the better your score is going to be. So I'm going to caution you on closing accounts. Because if you close an account, any credit account, if you're paying high fees, close the account. If you're not paying high fees for a credit card or any other credit relationship, keep that open, because that will increase your credit score because you have available credit, as long as you're not maxing it out and leaving it maxed out for an extended length of time. Okay, enough about credit reports. I'm going to whip through, kind of go a little bit fast through the financial statement section, because I know you guys have somebody else coming in to tell you about financial statements. So I'm going to just focus on the things that the surety company cares about, the surety company will be looking for. So I set this up on purpose this way. The financial statement should include a balance sheet and an income statement. The opinion page comes from the CPA, schedules of accounts receivable and accounts payable, and a work in progress report. The reason I put balance sheet and income statement at the top there is because those are the two most important pieces of the financial statement, and we do need both of them. Another term for income statement is a P&L. I've heard people say, and I think I heard people today even talking about a P&L. So income statement and P&L are the same thing. P&L is profit and loss. So the balance sheet and the income statement are the two most important pieces of this. The work in progress report sometimes is a part of it. I think the CPA is going to go into this a little bit. The work in progress report can be very useful. when you're doing larger long-term projects, but it's a good habit to get into to start working on a work in progress report when you're doing smaller short-term projects. So that way, when you do get into larger projects, you're already in the habit of keeping track of your work as it progresses. Schedules of accounts receivable and payable. Accounts receivable are going to be more important because that fits into some of the work that we do, the analysis we do behind the scenes. And if you have a lot of accounts receivable old or over 90 days, either we'll have some questions for you or we have to discount it on your balance sheet. All right.
Kara, we do have 2 questions here.
Okay.
The first one is on the LOC, the line of credit.
Mm-hmm.
So the company was offered a larger amount of line of credit versus their current amount. They wanted to save money because of the current climate. Would it look better to you as a surety bonder if they go ahead and get a larger LOC amount, or should they stay where they are if they have future bonding needs?
That's a really good and a very tough question because it's going to be really different for every situation. If, and I actually understand keeping your line of credit at a reasonable level because it does cost you. Sometimes, depending on the bank, sometimes if you have a smaller line of credit, it doesn't cost you anything. And as soon as you hit some threshold, then it starts costing you. Being approved for it, I want to just say is awesome. And in fact, that approval, if you can get that in writing, might be enough for a surety company. If though, there is a chance that you might actually need that increase, and only you, and actually you might not even know. You know, sometimes you're bidding on jobs, but you don't know if you're going to get them or not. So there might be some big jobs out there you're not sure if you're going to get. But if you have a pretty good idea that you might need that buffer, that line of credit as working capital later on, then you might want to do it. It's really so case by case, and even when it's case by case, it's really I don't want to say a personal decision, it's a business decision, but you need to take a lot of things into account. And what I would suggest in that case is to talk to your surety bond producer. And if you don't have a relationship with your underwriter yet, or if you don't have a surety bond program yet, at some point, once you're fully set up, we usually introduce you to your underwriter. And I think that's a really nice relationship to have. It makes my job easier. You have an idea of who your underwriter is and how they look at things. And that would be something to bring to your surety bond producer and to your underwriter and ask them there, because they're looking at all of your financial statements. And if you can give them an idea of what you're looking at in the future, they can give you some advice. And again, ultimately, this is your business decision, but they can give you some advice on whether you need to go with the bigger line or stay with the line that you have.
Thank you. Second question is about the credit score.
Okay.
We understand that you said earlier that you cannot tell someone what their credit score is, but if the company is applying to get bonded, would you, as an agent, be able to tell that company what their score is?
Nope. I know it sounds odd that I can know something that you don't know about your personal stuff, but according to the Fair Credit Reporting Act, I cannot tell you anything I can't tell you the score. There are some things on a credit report that are public record. So some things that are public record, meaning that I could have found out the information without having your credit report, are things like bankruptcies, tax liens. Those are things that I might be able to tell you about because it's public record. But anything else on the credit report, I'm not allowed to tell you. What I usually do is I try to be a little bit vague and say, there are some late pays, or there's some things that are past due. Go take a look at your credit report and come back and let me know what happened. If I can take a look at your credit and I see some stuff and we can address it And in my presentation, remember with the big red bow, if I can address it right up front with the surety company, that really looks great for you, even though there may be some things on your credit report that may not be great. If we can address it right up front, that will be helpful. So honestly, if you haven't regularly, at least once a year, gotten a copy of your credit report, I would suggest getting a copy. You can get a free copy of your credit report. Maybe Lily, you know the real website to go to. So I want to caution you on giving people your social security number and go to the correct website to get a free copy of your credit report.
Yeah, we actually have a program where if you are interested, applying for bonding or increase your bonding capacity, we work closely with the credit repair group that, will help and assist the firms, and we'll pay for that, for the fee.
Nice. Thanks, Lily. I know that probably wasn't the answer that you were looking for that, and because I can't tell you anything on your credit report, but any further questions on credit reports or anything else? Interrupt me. I'm happy to be interrupted. All right. Yes.
Okay, Kara, I have just a question. This is just my experience working for 14 years with my clients who are bonded. And one thing that always become a mystery for me, because my client said, oh, I already get, approved for bonding. And then, the bonding producer keep asking some questions like financial information. And then the client's like, why they keep asking, me a question, because I've done the financial part, you know what I mean? So let's say, my client already get approved for let's say $500,000 bonding. And then, 6 months later, they are interested in bidding in a project. And then they came back, they said, hey, Lily, why the bonding producer asking me for more information? I said, because the financial report, your financial changes every day.
Yes,
So can you just give the information to the firm so they understand why you guys keep asking more information, even though we've already done the underwriting part? Thank you.
No, this is awesome. Actually, I appreciate that question, Lily, because I use the analogy of applying for a loan. When you apply for a loan at a bank, you supply your financial statements, your financial information, you have the loan, you're done. But for surety credit, you're never done. It is a lot more work when you first get set up with a surety company. But like Lily said, if you're providing financial statements, you do need to continue to provide them on a regular basis. Typically, so traditionally, a surety company wants to see financial statements, which would be our balance sheet, our income statement, probably the ARs and a work in progress. They'll want to see it at your year end. And then they'll also want to see it at 6 months. So usually June 30. So if 12/31 is your year end, they'll want to see it again at June 30. And when I give you those dates, so year end is 12/31, we usually give you about 3 months to get those financial statements together. And then we need to update your financial file. Same with your June 30 financial statements. We'll need to update that. The surety company also, remember earlier on, I said they need personal financial statements as well. Personal financial statements will need to be updated once a year. Another thing to think about, and you made me think of this, Lily, is when I tell a contractor, you are approved for surety, yay, and let's say it is the $500,000, right? You're approved up to $500,000. There are a lot of exceptions in that potential authority that I have for $500,000. If the contract is, if it runs over a year or two, we'll probably have some more questions for you. We may need more financial information. If the contract is especially hazardous, if the contract is more than 1.5 or 2 times your largest job, if the warranty, workmanship warranty is more than a year, if I'm just trying to think of some of the things off the top of my head. There are a lot of things in that contract that could prompt a whole lot of extra questions from us. Keep in mind though, just because we're asking these questions, we're not asking just to be a pain in the butt, even though it feels like it. We're looking for things in a contract that could impact you as a business and a business owner. If you have a warranty period that stretches out 5-10 years, that is opening up a lot of liability for you as a company. You don't want to guarantee anything for 5 or 10 years. Neither does a surety company. If you have a contract that is usually, let's say usually your contracts are 6 months, and now your contract, you've signed a contract for 2 or 3 years, that opens you up for a lot of liability. I don't have to tell you guys what can happen in a year, right? So when we ask you these things, and when we're looking at a contract and asking a bunch of questions, keep in mind that the reason we're doing it is to protect you personally and as a business owner. Good question. I really appreciate that, Lily. Thank you. Okay, I'm coming up to the end. I'm just going to whip through these because I know the CPA is going to touch on these a little bit. I'm going to tell you what the surety company wants to see, and then the CPA can explain and go into more depth on what this is. So we have financial statement quality. So the quality of the financial statement is either internal, in-house. That means that you printed it from your QuickBooks. A CPA compilation is basically what it sounds like. It means that the CPA took your QuickBooks file, put it in a fancy, I hope the CPA is not here, put your financial statement in a fancy binder, and then charged you a few $1,000s for that. And hopefully the CPA can expand a little bit more on that. A CPA review means the CPA has actually looked at the numbers on your financial statement and has probably made quite a few adjustments when they do a review. The surety company wants to see any one of those things depending on the size and scope of work that you are doing. If you're going to stay under $500,000, internal, in-house might be totally fine. You start creeping up to $1 million or a little more, a really good compilation or a good CPA reviewed financial statement is what the surety company is ultimately going to be looking for, depending on what size contracts you want. The CPA audit, you probably aren't going to run into for several years unless you're doing somewhere between 40 and 60 million in revenue. So the audit, and a lot of people use the word audit, it sounds really scary. The surety company is probably not going to ask you for an audit. So CPA review, comp, or in-house, and this is a conversation you should have with your surety bond producer and your underwriter. The other thing, and I don't know how much the CPA is going to touch on this, is the financial statement method. So this is the method that you are counting the dollars that are coming into your company and the dollars that are going out of your company. The cash basis of accounting is only counting the dollars that are coming in and the dollars that are going, and the dollars that are going that have already gone out. So a cash basis of accounting is not going to count, it's not going to be accurate because it's not counting your accounts receivable because you haven't received it yet. You don't have the cash yet. It's not going to count your accounts payable because you haven't actually spent it yet. But you know that you have to spend it. You know you've got accounts receivable coming in, and the surety wants to make sure that you're keeping track of your accounts receivable and your accounts payable. So if you are not doing that, I would recommend to start doing that. What the surety company really wants to see is percentage of completion. And at that point, you will need a construction CPA to help you modify your financial statements in order to get you to percentage of completion. The completed contract method is a method that the surety companies doesn't recommend and is not worth even talking about, honestly. But it only measures the dollars of completed contracts. So again, it's not an accurate picture of your company. And really, I'm hoping, and I hope the CPA can help reinforce this too, I'm hoping that the financial statement is not just something that you have to give to your surety company and that you have to give to your bank, but is a tool for you to help you run your company. And that's really where the work in progress report is going to come. Okay, I do have a few more slides, but this could be a really good place to end if you guys are, because we're right at 1:20 right now. Is that cool, Lily, or do you want me to keep going? Yeah, so let's just quickly go to this is kind of the last one. This is for more information. If you want some more, I know I talked really fast and it's an hour. I hope you guys get at least something. And I think Lily and Jessica can get you a copy of this, this presentation. And if you find some more questions in here, please don't hesitate to reach out to me, to Lily or Jessica, or any of the other people here helping you out. They are an awesome research and a resource for you guys. Okay, I'm only 2 minutes over.
So Kara, we still have some time until
Okay.
1:30. So if people have questions or you want to go over some other materials.
Sure. Do you want to start with, see if anybody's got some questions first?
So people, don't be shy. Kara's here and your time is valuable in your learning. So if you have any questions, please feel free to unmute yourself and ask.
Kara, I'm just going to ask just because I work a lot with a lot of small business, and then we did a lot of workshops in the past.
Mhm.
Sometimes people feel like, well, I'm too small. I don't need bonding now. Can you just give us a little bit, like insight, like why small contractor need to start thinking about bonding, ahead of a game, because like, for instance, I have a lot of clients in the past, they piggyback a little bit with the prime contractor and then they could get away with it, like with the DBE. But at the end of the day, if you want to increase your capacity as a contractor and be successful, in a contracting, especially with USGOT bonding, it's really, really important. I was working with my client who's an 8A certified firm. And I told them that, that's going to be a differentiator. You have bonding compared to the other 8A firms, you will get the job. So can you just give us a little insight, like why it's important for a company who may think that now they don't need it? I mean, like something that maybe based on your experience working with the clients. I don't want to be like 2 days before, like somebody come to me, hey, I need a bonding, 48 hours. I'm sorry, Kara, because we work a lot for this.
Yes.
And I just want to encourage people. I mean, it seems like it's so daunting with all the financial part, but it's nice to get it done.
Yes. Well, so a couple of things. Yes, please allow some time. It's, you can probably go to your insurance agent and say, hey, I need $1 million worth of insurance. And they're like, sure, here you go. If you came to a surety bond producer, surety company, you say, I need $1 million worth of surety bonds, it's not going to happen nearly as fast. You saw all the stuff that we have to look at. And just because you have supplied the information doesn't mean that you automatically get bonding. The surety company actually is going to look at that information and analyze the information. So we do need some time. With that, yes, why apply for surety credit? Couple of things. One, other than your time, it's not going to cost you anything. You might as well know where you stand. If you don't need a bond right now, find out where you stand so that you can work on your credit. You can work on your financial statements. You can work on whatever it is that you need to work on for your company to make you not just available to get surety credit, but to help you be successful. All the things that the surety company is going to recommend for you are going to help you as a contractor be successful, right? Some of the things that we like to suggest are finding a CPA that understands your business, a construction CPA that truly understands your business. Find a banker, not just a bank. Banks are great, but a banker that understands your business. Not everybody here, I think, is in construction, right? We're a little bit there. Are there some service contractors here? There might be. Find a banker, find a CPA. Your partners should understand your business. You saw a little bit about the financial statements that I showed you, all the different things that you can do. Depending on your business, you're going to choose different things, and you need a CPA and banker that understand your business. Another thing about applying for surety credit and having it available is you are going to narrow your competition, right? Not everybody gets bonding. If you haven't applied, you might already, or if you have applied, you might already know not everybody gets bonding. So if you can get bonding, and if you're not ready for it yet, if you can find out the things that you need to improve on in order to get it, you're going to be a little bit ahead of the game, and it's going to be good business planning on your side moving forward. Does that help a little bit there, Lily? Thanks.
And also, if you ready and start thinking about it and would like to talk to Kara and I, like I said, we do have a special funding for companies because we have to work with a company who apply for bonding or increase their bonding capacity, so we could put some more funding to help your company to achieve that goal. So we could help you with the bookkeeper. Let's say your financial is done in-house and you feel like, oh my God, I entered everything incorrectly. And right, I mean,
Yes,
we've been through that part, Kara, all the time. Or maybe you you need review financial statement. I mean, that we could also provide that, but as long as you work, get your bonding or increase your bonding capacity with the goal, we're here. Like I said, you know, we are your cheerleaders, so we are gonna make it happen for your business. So anyways, thank you so much, Kara. I really appreciate your time, and I always appreciate my friendship with Kara. I've been working with Kara for the last 10 years, I guess. 10 years.
Well, when you
Helping-
told me your son was 7 earlier, I was like, oh, 7 years. Oh my gosh.
So yeah, feel free to ask her, like, you know,
Yes.
questions. So if you feel like shy now to ask, that's fine. Talk to us. Okay. I'll put all the contact information on the chat. Okay. Thank you.
Thank you, Lily.
Thank you, Kara.
Should I stop sharing here? Okay. Thank you again, everybody. I really appreciate this.
Thanks,
Thank you,
Kara.
Kara.
Today we have Peter Miller from Clark Newber, and he's going to talk about construction accounting and financial management. Everything that every small business owner needs to know. It's a tough reality out there, particularly if you're doing federal government work and the compliance issues that you have to have. So with no further ado, I'd like to turn this over to Pete Miller. Welcome aboard.
All right. Thank you so much. I appreciate the invitation to be here today and talk on this subject. Thanks for the introduction. So what I wanted to talk about today was more about, you know, you see the title here, Financial Statements 102. And what I intend to talk about is more about financial reporting and what, as you're growing your business, your financial reporting needs and your financial reporting audience is going to be broader and broader. And so what I hope to talk about today here is just what your audience is going to be looking for, as opposed to Financial Statements 101, which might be more of the bookkeeping, record keeping, and things of that nature, how to do the accounting. This is more focused on what those financial statements need to look like and how they should be tailored for a contractor. So, so we'll jump right in here. Maybe. There we go. So we'll start with just the basic financial statement components. There's 4 basic financial statements that I'll walk through in succession, kind of what they're telling you, why we use them, what your audience is going to be looking for. Any externally prepared set of financial statements is also going to have this set of notes and other materials, and I'll talk about what that looks like and what needs to be included in there. CPA reports on financial statements. So the word audit gets thrown around kind of generically, and that means something very specific to CPAs and to users of financial statements. There are other levels of service that you can get from a CPA that are not an audit, and I'm going to walk through those differences with you. And then just because of the day and age that we're in here, I want to talk through a few COVID-19 relief programs that are out there and give you a bit of an update on some of the programs that our clients are using and getting benefit from and where that's at. So that's how we're going to be spending our time. I've got about an hour planned here, so let's dive in. So first of all, the basic financial statements. So there's 4 basic financial statements that I'm going to walk you through, and I'll give you a bit of an overview here. But one of the core concepts when we're talking about external financial reports like this is something called Generally Accepted Accounting Principles, or GAAP for short. And just like it sounds, one of the key benefits of this concept here is that it's generally accepted. Everybody kind of knows what those rules are. The users of the financial statements are familiar with those rules. The preparers, meaning the folks like you and auditors like me, are all working from the same set of principles. And that way, the users know that for the most part, when they're looking at a set of financial statements, they'll know that this set of financial statements was prepared on the same basis of accounting as this financial statement over here. And they'll be able to know that we're looking at apples to apples, essentially. One of the core tenets of GAAP is the fact that it's based on historical cost. And so, something along the lines of inventory, for instance, if you're buying sheet metal and you bought it a year ago and you bought it for $100 a unit, maybe that sheet metal now is up at $120 a unit. To the extent that you still have some of that sheet metal around, the cost associated with it would be based on $100 a unit, not the market value of that material. Same thing with things like real estate and other pieces like that, equipment that you buy. It's all based on, for the most part, this historical cost concept, not market value. So whatever you bought it for is what you're recording it as in your accounting. So that's a core concept that runs through the majority of generally accepted accounting principles. So there's 4 basic financial statements. You can see them here on the screen. The first and foremost is the balance sheet, which is a snapshot as of a point in time. That balance sheet is telling us what are the things that we own or we have the rights to, and what are things that we owe other people or are obligated to pay. Those are liabilities. And then what's left over, this idea of owner's equity or stockholders' equity or shareholders' equity, partner equity, all of those kinds of things are the leftover known as equity. The next statement is more of a period of time. So we're looking at, say, 3 months, 6 months, or 12 months. Typically, external financial reports like the ones that I prepare are over a 12-month period or over a year, and that's your income statement. So this is kind of your scorecard. How did we do during the year? How was our revenue volume during the year? How was our margins? How was our bottom line? Those kinds of things will be shown on the income statement. The balance sheet is more of a health check as of a point in time. What's the financial condition of the company? Do we have enough assets to pay our bills? How much debt do we have? Things of that nature. And then the last 2 statements are really kind of focused on 2 elements of the balance sheet. One is a drill down inside of that owner's equity portion of the balance sheet. And here we're wanting to know what kind of activity is going on in there. Do we have any contributions that are coming in from the owners? Are we paying money out to the owners in the form of distributions? And what else is going on in there? So users of the financial statements like to know a little bit more specificity around that particular piece. And the same thing with cash flows. The statement of cash flows is probably the most confusing or less understood of the 4 basic financial statements, but it also has some of the best information on it. And so I'll go into more detail here as we move along. So let's start with the balance sheet. And here, one thing that the balance sheet carries for us is this fundamental accounting equation that assets equal liabilities plus owner's equity. That's what I'll show here. And let's talk about what are assets. Typical assets for a contractor are certainly going to be liquid assets like cash or CDs, cash equivalents, marketable securities. But then it's also money that is owed to you, accounts receivable, meaning that you've issued an invoice to your customer and it hasn't been paid yet. So that you've done the work, you've earned that money, but it just hasn't been paid yet. So that's an account receivable. That's also an asset. Contractors typically track what's called work in process, which is, I like to think of that as an uncompleted invoice. Perhaps you've done some work on a project. You're building up enough completion on that project to be able to issue an invoice, but you haven't finished it just yet to be able to issue an invoice. That work that you've completed so far on that uncompleted invoice, it's called work in process. It's also an asset that you have a right to be able to build up that work in process and issue an invoice later. Inventory, property and equipment certainly is an asset, and so forth. On the other side of the equation are liabilities. So what do we owe to other people? So that's typically called accounts payable. Those are the bills that come in that you need to pay. Accrued expenses is oftentimes payroll related, but these are things that don't necessarily have an invoice associated with them, but they're still costs to the business and things that you owe. Payroll is a good example. And then debt, any line of credit that you might have, or equipment loans, or a mortgage on your building or something like that. All of those things would be included in debt. And then the leftover is equity. So you might issue stock, that's included in equity, and then retained earnings is essentially the leftovers that have not been distributed out of the company. One core concept that users of the financial statements like to talk about is something called working capital. Working capital is a measure or a ratio that's used to figure out how healthy is the business and what is its ability to be able to pay its bills. So it's the ratio or the comparison between current assets and current liabilities. And when we use the word current, what we're getting at there is from an asset standpoint, is the asset cash today, or will it be converted to cash in the next 12 months? And so typically things like accounts receivable, work in process, and inventory are assets that are expected to be converted to cash in the next 12 months. You're gonna work on a project, you're gonna use that inventory, you're gonna get paid for it in the next 12 months. So that's current assets. Same thing on the other side. Current liabilities are uses of cash that you expect to use in the next 12 months. So you expect to pay your bills within the next 12 months. You expect to pay a portion of your long-term debt, a mortgage, an equipment loan, in the next 12 months. So all of those things are captured that way. But again, it's a measure of how healthy is the business and how able are you to pay your bills from the current assets that you have in hand right now. Okay, so the next is the scorecard, is your income statement. So this provides an accounting measure of revenues earned and costs incurred. And this is usually pretty summarized information in an externally prepared set of financial statements. It's not going to look too unlike this, actually. So you've got all the revenue that you've earned on your projects at the top line. And then you've got this thing called cost of goods sold, which is typically any costs directly associated with your contract. So your materials costs, your labor, any subcontractors that you might have used, permits and things of that nature, all get included in this cost of goods sold. And then that breaks down to gross margin. So gross margin or gross profit, you can hear those things used interchangeably. Basically, what we're getting at there is how much money are you making specifically on your projects. And that'll vary depending on the type of contractor that you are and the type of work that you're doing. And sometimes that's expressed in a dollar amount, sometimes it's expressed in a percentage, but either way, gross profit, gross margin is basically how much money you're making on the project itself. Then below that line are selling and general and administrative expenses, essentially business costs that are supporting the operation of the company, not necessarily specifically related to a certain project, but they're necessary costs that are supporting the business operations. And then we've got depreciation. And earlier when I talked about building and property and equipment and things of that nature that go on your balance sheet, you may pay for a piece of equipment all at once, spend $100,000 on a piece of equipment, but you're not going to expense that $100,000 right away for purposes of GAAP accounting. For purposes of GAAP accounting, they like to spread that cost evenly over the expected life of the asset. So let's say you buy a piece of equipment for $100,000 and you expect that it's going to last 10 years. Then you would write off or deduct $10,000 of depreciation for each year over the next 10 years. That's this depreciation expense. So that goes in there. And then you've got some other operating expenses. All of that drops down to operating income. And operating income is basically, how much money have you made after you consider all of these costs associated with supporting your ongoing operations and the costs associated with your projects. So that's another key measure that users of the financial statements are going to be looking at. And then below that are some other kind of various sundry items. Interest, income, or interest expense, income taxes, things of that nature will all come down to your bottom line or your net income. So if we think about this, so you've got your service revenue and costs associated with your projects, and then you've got what is called overhead, or those supportive costs here in the middle. And a key thing that users of financial statements really love to talk about is EBITDA. EBITDA is something you hear thrown around, and it's actually an acronym. You can see what it is here on the screen. And what EBITDA is getting at is earnings before interest, taxes, depreciation, and amortization. And the reason that we track those things separately, and why users of financial statements really care about this EBITDA, is that it's a proxy. It's a simple way to measure the operating cash flows of a business. How much cash is going through your organization? How much cash are you earning from your operations? These other concepts, interest and taxes, both of those things don't really have anything to do with your operations per se. They have to do with how you're financing your organization, whether you have debt or not. Your interest costs will vary based on if you're carrying debt or not. Doesn't really have anything to do with how you're operating, how successful your operations are. It's just got to do with what you're doing from a financing standpoint. Same with taxes. Some companies are organized as an LLC or as an S corporation, and so they're not going to be paying taxes directly as an organization. Others that are incorporated as a C corporation will be paying taxes directly. And so from an apples to apples standpoint, backing out those taxes will allow somebody to measure and compare different companies with one another. And then depreciation and amortization aren't necessarily cash expenses in the year that we're looking at. So let's say 5 years ago, you bought that piece of equipment for $100,000. The $10,000 depreciation that we're recognizing this year, you didn't pay cash of $10,000 this year. You paid $100,000 5 years ago. So we're going to back out that $10,000 because it doesn't really have anything to do with cash this year. So this is just a really close and easy way to measure this operating cash flows, which are so important for analyzing the kind of health and viability of a business. So that's something that gets tracked really closely. It's really closely associated with the income statement, which is why I brought it up here. Okay, so now we're going to talk about this owner's equity statement or members' equity or shareholders' equity statement. And this is what, accountants love to build these things called roll forwards, that you start with a balance at the beginning of a year, and then you track all of the activity in different buckets throughout the year. So in this case, what we're doing is we've got the beginning of the year here, January 1st, and you may have issued some stock to new owners. That would get tracked here in this line item. You may have paid a dividend or a distribution to your owners. That would get tracked here as a negative item. And then when it comes to owner's equity, your annual performance gets dropped in here as well. So your net income for the year, or if you had a loss, your net loss would show up here, and it gets dropped into this bucket called retained earnings. And so the balance here at December 31st, the balance here would match up with what you see on the balance sheet. These two things absolutely correspond with one another. And so, again, this just provides a little more detail as to what's going on in here. Depending on your banking situation, we see sometimes that banks like to restrict how much of this distribution activity can take place. They want to make sure that you're leaving enough cash in the business so that it can pay its bills and be healthy. And so they can restrict the amount of money that is flowing out here in this line item of dividends and distributions. So that's a key reason why they want to look at this activity, is to be able to monitor what's going on there. Okay, now on to the cash flow statement. Again, this is one of the least understood of the statements, but it's got some really powerful information. And again, this is a roll forward of sorts. So we're looking at cash at the beginning of the year, and we are measuring a whole bunch of activity that took place throughout the year. and then we're going to end up with cash at the end of the year. And we break this down into three big buckets of activity. One is based on your operations. Another is based on what's called investing activities, which I'll talk about. And then the other is financing activities, which again, I'll talk about. So let's go through each of these. So with operations, again, this is something that's going to be fairly close to that EBITDA number. The total amount of cash flow that you earned from your operations is going to be fairly close to this EBITDA. So you start out with net income, and you'll back out the depreciation piece. You'll back out a few other items. You'll back out this change in working capital, which again, this is where it kind of starts to get confusing. But if you issued an invoice at the end of the year for $10,000, you would record revenue. You would have earned revenue of $10,000, and you would have a receivable of $10,000, but you haven't been paid on it yet. So you haven't gotten the cash associated with it yet. And because you haven't gotten the cash associated with it, we have to adjust for that. And that's what these pluses and minuses are all about in this section of the statement. There's some fun you can have with spreadsheets to come up with how to calculate this kind of stuff, which, you know, we certainly have built spreadsheets to help us the cash flow statement. But that's what this is getting at, is how much cash have I either earned from my customers or paid to my employees and my vendors on an annual basis. And you come down to this operating cash flow total. The next category is investing activity. And investing isn't necessarily how much money am I putting in the stock market? How much am I buying in mutual funds and stocks and bonds and things like that? It certainly can be, but an investment in your business, most commonly for a contractor, is going to be the purchasing of equipment. You're investing in long-term equipment or a building or any number of long-term items like that, capital expenditures. And so that kind of activity gets captured here. If you spent $100,000 this year on a piece of equipment, that $100,000 would be shown as a cash outflow in this category. And so you come up down to a total of investing cash flows. Then the third bucket is your financing activity. And so here you could get a loan to buy that $100,000 piece of equipment. The money that you received from the loan would be a cash inflow in this bucket. You may have paid dividends or distributions to your owners. That would be a cash outflow in this bucket. That type of activity happens here in the finance and cash flow section. So at the end of the day, you take the sum of all three of those buckets. How much did our operations make? What did we spend in investing, and what happened in our financing activity? You take the sum of those three things, and that will equal the change in the cash balance that's on your balance sheet at the beginning of the year versus the end of the year. That change will add up to this number right here. So again, this statement absolutely corresponds with your balance sheet, and all of this should flow together between the balance sheet, the cash flow statement, the equity statement. Everything should kind of be related. Okay, so those are the basic financial statements, and that's a big part of where GAAP resides in the work that we do, is in analyzing all of that information. There's more to it though, and contractors have some unique things that have to be included in external financial reporting. There are some required supplements. One is notes to the financial statement. So in a externally prepared financial statement, you're going to have these notes, and they're really, really important. And this is where the beyond the numbers kind of information comes through, and it helps tell the story of what's going on with the numbers that we're seeing on these financial statements. They go into greater depth about accounting policies and how, to the extent that you have judgment in the way that you can account for things, we tell that story here. We tell you, the reader, how are you accounting for various things? And I'll go into a little bit of what some of these key disclosures are. So we describe the business and the reporting entity. Oftentimes we'll find that contractors They may own their building, and they could hold that building in a separate LLC and lease it back to the company. Sometimes they don't. Sometimes they hold that building in the same corporation as the operating entity. So we've got to describe what is it that we're actually auditing or reviewing, and et cetera. Greater detail about general asset and liability categories. How do we record and value accounts receivable? How do we record and value inventory? How do we record property and equipment? All of those kinds of things. There's some decisions that you get to make there. And we need to disclose what those decisions are and how you came to make those decisions. How you recognize revenue from contracts with your customers is a big deal. Contractors have some unique revenue recognition requirements that are fairly typical, and we need to describe in some detail how that's coming to be. The terms and maturity of credit and other long-term debt that you have. Any concentrations that you have with customers. So I work with a contractor, a general contractor that builds Costco's, and they build a lot of Costco's. In fact, in any given year, anywhere between 70 and 90% of their revenue will come from Costco. And so they've got a great relationship with Costco that is worth a lot to them, but it's also a risk. With that much revenue built up in one particular customer, what happens if Costco decides not to build any new stores next year, or for whatever reason, that contractor falls out of favor with Costco and they get cut off from any future projects. The health of that business would be called into question. And so, significant concentrations like that need to be disclosed so that the reader of the financial statement can get a full picture of what's going on. Same thing with related party activity. We'll often find, like I said before, that a contractor maybe owns the building. The owner of the contracting business owns the building that they operate out of, but they hold it in a separate LLC, and they're leasing it back to the operating entity. That lease expense needs to be disclosed as a related party activity, because it may or may not be, well, the assumption is that it wasn't at an arm's length transaction, that if it was negotiated between the contracting business and a totally independent, separate third party, that you may have had different terms than you otherwise would because you were negotiating with yourself, essentially. That kind of activity needs to be called out separately. And then any purchase commitments that you might have, or any contingent liabilities that might have come up, like a lawsuit or an IRS audit or something like that is pending some cost that's lingering out there that you're not sure how much is going to be. Stuff like that needs to be disclosed as well. Okay. And then when it comes to contractors, there's some other material that gets tossed in on top of that. And again, these are things that the users of the financial statements really care about and that they dive into. We oftentimes will see on the income statement, that I showed you, it was really, really condensed and summarized. We'll see some of that get detailed out in some supplemental schedules, and I'll show an example of it here in a few minutes. And then there's a couple other schedules that get tossed in there, a list of all the contracts that were completed during the year, and a list of all the contracts that were in progress at the end of the year. And there's a few reasons why those need to be included, and I'll mention that as well. So this is an example of a kind of a detailed statement of cost of revenues, or that cost of goods sold, where we're detailing out what the direct costs were. Like I said before, could be your labor, materials, equipment costs, subcontractors. Same thing with indirect costs, small tools, depreciation perhaps on construction equipment, permits, and so forth. Some users of the statements like to see more detail when it comes to this kind of thing. So we include it here. Same thing with general and administrative expenses, that it may be useful to see this in more detail. And so that, this would have all been summarized in a single line item on the income statement, but you can see the detail here because we've exploded it out like this. So just depends on what the users want to see. So then we'll come down to what I think is really the heart and soul of a contractor's financial statements is their WIP schedule. And if you're doing a WIP schedule, you know what I'm talking about. If you're not, I'll share a little bit about why it's important and why users of the financial statements are looking for it. For starters, if you're going to do an audit, or if you're going to do a review, if you're going to do financial statements that are in compliance with GAAP, GAAP requires this kind of schedule to be prepared as a part of the revenue recognition process. So for starters, it's a good thing to put this together just for that alone. But it's also really, really important as a tool for managing your business and seeing how each of your jobs is coming along. It provides a summary report. It helps you identify job trends, opportunities, and problems, things of that nature. I'll show an example here in just a second. It helps you identify cash flow or billing challenges. And it also tells you how much work do you have left? How much work is on your plate right now? And when it comes to surety bond providers really like to know how much work do you have in process right now. And the reason that they like to know that is because if they're going to be providing a bond to you, they want to know how much they're bonding or how much is on the table right now. So they look at this specifically to try and find out how much work do you have coming your way. Okay, so this is an example of what a completed contract schedule looks like. And you'll see that it has some kind of contract number or identifier, the name of the project to help you kind of figure out what we're dealing with here, and then some information about each of the projects that's detailed out. So how much revenue have you earned on the job so far? How much cost did you spend on the job? And what was your gross profit from the job? And then, the gross profit percentage. And then typically what we see, again, these are all completed contracts. Contracts are jobs that got completed during the year. What we typically see is that it's broken out between how much activity took place in the last 12 months. You see that here in the last 3 columns, revenues, costs, and gross profit. And then how much activity happened before then. Some contracts can go on for more than 12 months. And so, or even if you had one that spilled over from year to year, how much happened in this year, how much happened in this year, we like to separate that out. Okay, so then what we're going to look at next is this WIP schedule. And this is, it looks a little similar to the completed contract schedule, but it's not exactly the same. Again, you'll see that there's a contract number and the contract name. There's the current contract price that's associated with the job. This would include any negotiated change orders or claims that you've negotiated. All of that gets included in here. And then you've got your costs so far. How much have you spent on the job so far? And then how much do you think you have left to spend? So this is really, really important. And this is something that, again, because your revenue recognition is built off of this schedule, this estimate to complete is really key, because that drives how much margin you expect to have when the job is all said and done. So that's kind of the job overview. And then again, you're breaking this down into the total revenues that have been earned so far in the job. This will generally be a formula. The cost of revenues earned, gross profit so far on the job, how much have you billed on a job-by-job basis so far, and then again, just the 12 months that we're looking at, how much revenue have you earned and so forth here. One key and kind of unique thing about contractor accounting is that the amount of revenue that you earn doesn't necessarily correspond to the same amount of invoicing that you've had. So for a manufacturer, typically the amount of what you've invoiced is the same amount of revenue that you've earned. You ship 100 widgets, you get an invoice for $1,000, you recognize in revenue for $1,000. With contractors, the way that it works, just a second here. Sorry about that. My dog wouldn't let me alone. I had to let her out. With contractors, the way that this works, so let's say you've got $1 million contract and you expect to spend $800,000 in costs on that contract. So you're going to earn a 20% margin or $200,000. The way that revenue recognition works for contractors when we're talking about GAAP is that you get to recognize revenue based on the proportion of costs that you've spent so far. So like I said, you expect to spend $800,000. Let's say that you spent $400,000 so far. So you've spent half the money that you expect to spend on the project. That means that you get to recognize half the revenue that you expect to recognize on the project, or in this case, $500,000, half of 1 million. So the revenue and the expense are recognized kind of at the same pace over the life of the contract, all based on how much cost you've incurred so far relative to the total amount of cost you expect to incur when the project's all done with. So like I said before, that could be different from the amount of invoicing that you've done. Let's say that you're able to recognize $500,000 of revenue, but you've only invoiced $400,000 worth of invoices. So there's a $100,000 difference there, and that gets loaded into that work in process asset that we talked about at the very beginning, kind of that uncompleted invoice concept. So that's where this column here, we refer to this as an underbilling. That's where this difference shows up. And it could be the other way. It could be that you're able to invoice $600,000, but you only have incurred, or you're only able to recognize revenue of $500,000. So you've got $100,000 overbilling, which is okay. It's not a bad thing, but it's just the way that the accounting works. Generally speaking, on any given project, you will be a little bit different in your invoicing and the amount of revenue that you get to recognize, either on an underbilling perspective or an overbilling perspective. This schedule allows you to calculate how much am I overbilled or how much am I underbilled on a job-by-job basis. And if you were to see an Excel-based version of what you see on the screen, about half of these columns would be formulas, and about more than that, probably 3/4 would be formulas, and the remainder would be a few fields where you've got to enter data, and the rest of it just kind of tells you where things need to be. Really important schedule, and again, lenders are going to look at this, surety bond providers are going to look at this to help kind of analyze where did you make your money, where are the projects, the next year's projects going to come from, things of that nature. Okay, so let's change gears a little bit, and we're going to talk about the CPA's role in financial reporting. And like I said before, there are a handful of different ways that users will gather information about a company. And the base level really starts with internally prepared documents. It could just be, send me your QuickBooks financial statements, and I'll take a look at that. It could be send me your tax returns as a place to start. And what we see is that's generally where sureties and lenders will start looking at things is on internal reporting like that. And then as you start to borrow more, or as you start to need more bonding coverage, the rigor and the requests for more information kind of amps up. And at that point, they may say, well, now you're borrowing or you're bonding a little bit more. We want you to provide what's called a compilation. And then it could go up to what's called a review. And then finally, it may go up to kind of the top level, which is an audit. I'll talk about the differences between those three things here in a second. But you can see just by the size of the font, I did that on purpose to show you that each of those three things comes with it a level of effort and complication. Compilations are fairly straightforward. Reviews are a little more complicated, and audits are kind of the most complicated part of CPA's role in financial reporting. And what I find is that there are these kind of thresholds that sureties and banks use when they ask for these different things. And what I find is that, you know, if you are a $25 or $30 million contractor, you know, you may be in a review, but your bank and your surety are probably looking at these thinking, well, we're going to need to move to an audit pretty soon. So somewhere in that, you know, 30 plus range is going to be where you're going to need to do an audit. Somewhere in, you know, the maybe starting at around $10 million, you may need to do a compilation. Maybe starting somewhere around $15 or $20 million, you may need to do a review. So those are some of the stage gates that you will work through as you grow as a business, and the things that you need to be prepared for as you grow as a business, as it relates to, you know, expectations of your surety bond provider or your bank. Okay, so each of those three reports that I talked about, the compilation, the review, and the audit, they look quite similar as far as the basic four financial statements, the notes, the supplemental materials that we've been talking about. All of that gets included in each of those reports. But the difference is how much work the CPA did relative to verifying that any of that information is accurate and correct. And there's this expectation gap between the CPAs and the users of these reports. Essentially, anything with a CPA logo on it is deemed to have been audited, and that's not entirely true. There's a letter that gets attached to each of these reports, a compilation, a review, or an audit, that says specifically what the CPA did and what they didn't do. So I'll walk through that with you here. The most simplest is the compilation. And so with a compilation, what we do is we get some accounting information from you, and we prepare the financial statements just like I showed before, and the notes and the supplemental schedules and so on. We make them look the way that they need to in order to comply with GAAP. But we're not providing any assurance at all. We have not kicked the tires. We have not been asking questions. We're not verifying anything that those numbers are accurate or correct. We're simply taking what you provided to us, and we're preparing financial statements. So then the next level up, we step it up a little bit. We do exactly what we did in a compilation, but we also, now we do start asking questions, and we do start running some ratios and seeing if things make sense based on what we're seeing there. And we provide what's called a limited assurance, where a CPA is saying, basically, nothing came to our attention that suggests anything was wrong in these financial statements. That's a review, and it's this kind of middle level. Then we move up to an audit. And with an audit, not only are we doing everything that we did in a review, we're asking questions and doing analytical procedures, but now we're also looking outside of the organization's records. We may be sending letters to customers or to your bank or to attorneys to ask about information that we're seeing in the accounting records. Like, very commonly, we'll say, hey, our accounting records say that, you know, you, customer, owe us this amount of money on this project that has this contract price. Do you agree? And the customer will fill it out and send it back and say, yes, I agree. And that gives the auditor some comfort that, okay, well, the numbers that we have in our records match up with the numbers that the customer has in their records, so they must be right. We'll also start looking outside of, we'll look at invoices. You know, that $100,000 piece of equipment. In an audit, I would want to see, show me the invoice for that $100,000 piece of equipment, and probably let's walk out to your shop floor and you can show me that piece of equipment because I want to get my eyes on it. So we take a much serious approach to verifying that activity is based in some kind of support. And then we also do a study of internal controls. So not only do we care that the numbers are correct, but we want to see what those checks and balances look like throughout the life of a transaction. Who is signing off, is reviewing it and approving it, and all of those steps that happen along the way. And so in an audit, we provide what's called reasonable assurance. So now we're saying that based on our testing, that we feel these financial statements are accurate. They're complete and they're accurate, and it's a much more direct and positive type of assurance as opposed to this nothing came to our attention stuff that you saw with a review. And also, before I jump into this, I'll say that you know, the amount of effort as you move from the top to or from the bottom to the top, the compilation, up to the review, up to the audit. The amount of effort and preparation that is required from our clients goes up and up and up. And our effort certainly goes up and up and up, and so does the cost. And so the idea being that as you grow as a contractor, you've got more activity, you're earning more margin, you're earning more net income. And the bank is kind of, or the surety is taking on more risk by kind of lending more or providing more bonding coverage. And so the cost associated with each of these steps comes along with growth of the business. So that's important to keep in mind. Okay, so like I said before, this day and age, COVID being what it is, there's some relief programs out there that I wanted to talk about, give you a bit of an update on. A number of our clients have been taking advantage of these programs, and I imagine you have as well. So I just wanted to share some of these latest updates, again, to give you some background. So two things I really wanted to talk about. There's a number of different relief programs that are out there, both at the state level and the federal level. But I'm going to talk about two that I'm seeing quite a bit of activity, again, with our clients. One is the Paycheck Protection Program, and then the other is the Employee Retention Credit. So let's dive into the Paycheck Protection Program. So if you really wanted to know read the legislation that these two programs are embedded in, it's called the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act for short. And that's where the legislation came from for the Paycheck Protection Program for those loans. If you want to get into the heart of it, you can jump out there and search for that. But there's a bunch of other resources out there as well. The IRS has some great resources on their website. The Small Business Administration, which is the agency that issues the loans, they've got a ton of information on their website and some FAQs that are updated pretty consistently. The American Institute of CPAs, that's the trade association for CPAs at a national level. They've got a lot of great data. You can go out to their website and just search in your browser for AICPA PPP loan. Payroll providers are enabling calculators to help you figure out, how much can be forgiven and so forth. And then if you want, you can go to clarknuber.com. We've got a ton of information available out there, articles and information about different relief programs and how they're deducted and how they're handled for tax purposes. So I encourage you to go out there, and we've got a dedicated resource page for these kinds of things on our website. Okay, so let's get into the Paycheck Protection Program. One of the questions our clients ask is what can you spend it on? And there's 4 different categories that you can spend it on. One is your payroll costs, and that's really the primary intent of the program, was that the monies would be spent on payroll costs, but there's other qualifying expenses too. If you had a mortgage or a loan in place, interest on that mortgage, to the extent that mortgage was in place before February 15th of last year, that's an eligible expense. Same with rent on a lease that was in place before February 15th of last year. And then utility payments. Those are the 4 categories that are eligible for reimbursement in this program or for forgiveness of the loan. There's a couple different ways you can count for it. And there's a great article and white paper on the AICPA website I've listed here that you can check out. But there's one way that you can account for it is simply as a loan. You received $1 million loan under the PPP program, and you record $1 million of debt on your balance sheet and $1 million of cash received. The other way that you can account for this is as a government grant, which kind of accelerates some of the your ability to take the loan off of your balance sheet. So ultimately, the idea with this is that if you spend the money the way that you should in these 4 categories, then the loan should be forgiven. And ultimately, you're not going to need to pay the loan back, but the SBA will provide some forgiveness, official forgiveness, and you'll be able to write off the loan, write it off of your balance sheet. And that's kind of the key part of this is how do you account for it? And what this article addresses is how do you get it off of your balance sheet? And depending on if you treat it as debt or government grant, there's a couple of different ways you can get it off your balance sheet. Anyway, so more importantly, how does the loan forgiveness work? And so in order to achieve the maximum loan forgiveness, there's a few steps that you need to go through. One, you need to utilize at least 60% of the proceeds on payroll costs. So they really want to drive home that the money is really meant to help your employees and to continue to pay them. The entire loan proceeds need to be spent on eligible expenses. So those 4 categories I talked about. You need to have the same number of employees at the end of the covered period, or the length of time that you're allowed to spend this money. You need to have the same number of employees at the end of the period as you did at the beginning of the period. Or you need to restore wages to employees by the end of the covered period. So as opposed to, we're going to keep the number of headcount, but we're going to pay them 75% of what we used to pay them. In order to get full forgiveness, you need to be paying them 100% of what you used to be paying them. There's a few exceptions to this FTE or full-time equivalent rule. If a government agency required you to close, then you would get to waive that FTE piece. If you restore the number of employees by December 31st of last year, then that's considered an exception. Also, if you made a bona fide offer to rehire somebody and they turned you down, and you can document that, then that gets covered as well. That's an exception as well. So then some key dates to keep in mind. The forgiveness application, you need to file that within 10 months after the covered period ends. And the covered period can be 8 weeks from the date you got the loan, or it can be 24 weeks from the date you got the loan. We're seeing a number of our clients elect that 24-week period. So, 10 months after that 24-week period is like a year and a half in total. So you've got time to go through this forgiveness application process. But once you file the application with your bank that gave you the loan, they have 60 days from the receipt of the application to approve it or reject it. If they approve it, they'll pass it along to the SBA, and then the SBA has 90 days from the day they receive it to approve it or reject it. And so those are just some key dates to keep in mind. So then what happens if the full amount isn't forgiven? Then it's just treated like an ordinary loan. Let's say that you got $1 million loan, you go through the forgiveness application process, and $800,000 of it gets forgiven. Now you have a $200,000 loan on your books, and you need to pay off a $200,000 loan according to the terms of the loan that you got, which typically there's 2 or 3 years that you need to pay it back on 1% interest. So you'll need to just start paying that off like you would any other loan. So that's what happens if it's not all forgiven. So then the SBA has also announced that they plan to audit any loans that are $2 million or greater. So if you got a loan that was over $2 million, you can expect that the SBA will come and audit you at some point. They also reserve the right to audit any loan that's under $2 million at their discretion. So it could be just entirely random. It could be because there's something to do with your loan or your application for your loan that they are suspicious about, perhaps. But they could audit any loan they want to. But they've just announced that anything over $2 million they will audit for sure. And they've said that they've given themselves 6 years after the date of the loan to do this audit. So, my best advice is to gather up a bundle of information that helps support the fact that your loan should be forgiven, and then just put that on a shelf and hold on to it for the next 6 years, because the SBA will come, or has the ability to come, within 6 years after the date that either the loan is forgiven or that it's paid in full. So then what will be audited? So they're going to look at the eligibility. Were you eligible to get the loan in the first place? And essentially the key eligibility factor is did you have a need? were you worried about your ongoing operations such that this loan was going to provide you relief? And for contractors, it's not a hard test to pass that test. This industry's been hit pretty hard, particularly at the beginning when work basically just couldn't happen, and so it's pretty easy to get across this hurdle. If you have a loan that's less than $2 million, you're deemed to meet this standard, period, without any contest. So that's good to know too. They're going to test or audit the loan amount. They're going to audit the way that you use the money, and they're going to audit your loan forgiveness calculations. So they're going to go through each of these steps. So the last three are fairly objective. The first one is a little subjective to the extent that you borrowed more than $2 million. So in summary, a couple other things I want to point out. There's a bit of at the beginning, the Congress, when they passed the CARES Act and had this idea of the PPP loans and forgiveness, their intent was that the income that you received, the money you received, would not be taxable. And what their intent also was that the money that you spent to pay for your payroll and your utilities and your interest and your lease payments and so forth, that would continue to be deductible. Well, at the end of the day, when the law got passed over to the IRS or the U.S. Treasury, they came up with a different way when they wrote the rules, and so they're saying that if you're receiving these proceeds and you're not going to recognize any taxable income associated with the proceeds, well, then you can't deduct the expenses either, which basically makes it taxable. So Congress is working with the IRS to kind of fix that. We're getting close on it, but stay tuned on that and keep in touch with your CPA about how that's going to work out. With the PPP loan, document why you needed it, document how you're spending it, and to the extent that you have any money left over, or if you got a second PPP loan, we've been recommending that you keep it all in a separate bank account just so that it's really clear the money leaving that bank account, how it was spent, if it was spent on payroll or lease or what have you. It's really clear how you spent it. So really quickly, with the few minutes we've got left, I want to talk through the employee retention credit. So this is another mechanism to provide relief for businesses that experienced a decline in revenues. Originally, when the CARES Act came out, you could only apply for the PPP program or the employee retention credit. Now the rules have changed and they allow you to do both retroactively. So are you eligible for the employee retention credit? This is related specifically to any wages that you paid to retain non-working employees. That's really key. If you made any payments to people that weren't working, so particularly at the beginning of the pandemic, we saw some businesses spend some money, and if you had shut down all of your contract projects, but you were still paying your people, that would qualify here. If you had a decline in more than 50% of gross receipts or revenue from the same quarter in 2019 compared to 2020, or as we're sitting here in 2021, of 20% decline from the same quarter in 2020, you'll be eligible. 50% of wages paid to an employee up to $10,000 annually in 2020 could be coming back to you as a credit. And then 70% of wages paid to an employee up to $10,000 quarterly could be coming back to you in 2021. So there's a lot of money that is depending on how much money you paid to employees that weren't working, and if you're still doing that by chance, you can get reimbursed for those dollars through this program. The key thing that like I said before, originally you were only allowed to do the PPP or the employee retention credit. Now you can do both, but the caveat there is that the wages cannot have been reimbursed by other relief programs like the PPP. So you can't double dip. That's the key thing. Great article out there on clarkhuber.com. I want to point you to give you some more information there. advice going forward. Like I said, the SBA has a ton of information on their website. Keep checking back on that. The FAQs are getting updated all the time. Make a few hours a week for you or somebody else in your company to understand how things are moving and what you need to do. Talk to your CPA, talk to your bank, and understand the programs that are available out there, what relief is available to you. Yeah, and then hopefully I've saved some room for some questions. And I told Jessica this, I've got to transition a little bit here to go pick up my daughter from school. So I'm going to step away from my computer, but just I'll keep, I will keep the phone going so that I can talk, but you just won't see me. So I will stop video, and I'm happy to answer any questions that might have come in.
Well, folks, right now is the time to ask your questions. Normally, P charges at least, I would say, $300–400 an hour. So right now is your opportunity to ask him any questions that you may have.
That was a pretty good guess. And I'll say that if a question hits you later, I'm absolutely open to answering questions through email or phone call or whatever. If you want to, my preference would be email. So if you want to send me an email with your question, I'm happy to address that too.
Well, it's a pretty quiet group here. I think that we'll, we should probably go ahead and just let Pete head out. And if anybody has any questions, go ahead and put them in the chat. Or if you have, you can look at the last slide on there. And Jessica, maybe if you could put that in the chat, the contact information for Pete. And then either, we'll try to get them answered for you, or you can call Pete directly or text him or something.
Will the slides be available from Pete's presentation?
Yes, it will.
Thank you.
Pete, are you still there?
I'm here. Can you hear me?
Yeah, my name is Angelica Duncan. I work with a small asphalt construction company, and I'm wondering if maybe you could give me some advice. So we did some work with a prime contractor over the summer, and the job at the end of the day didn't get accepted because the HMA statistical evaluation compaction test did not pass. And there's a whole long story behind this, but what it boils down to is the HMA compaction test is supposed to be done on site while the work is being performed, but the statistical evaluator for this test did not show up. And we were told by the prime contractor to just proceed. And so we're waiting for over $25,000. It's been a very long time since the summer of 2020. And right now with COVID and everything, things are kind of in a pinch for us. And we feel like we're being ghosted by this prime contractor. They're not reaching out to us whenever we ask a question. And the big question is who was responsible for that test, because it was either the prime contractor or King County. And like, we're stuck. Like, no one is responding to that question, and we're waiting to get paid. Do you have any advice on like how to get to the bottom of it?
Yeah, that's a great question. Well, there's a couple of things that come to mind. I mean, you can, there's a chance that depending on who the owner is of the project, you could bypass the prime contractor and start bugging the owner. That might get the attention of the prime contractor and prompt a response from them.
Yeah.
The other is that you could put a lien on the property, and that's another way to prompt a response from the prime contractor or the owner is if you put a lien on the property for, the $25,000 that you feel is coming to you, that's another way that'll get their attention. They'd rather not have liens, and that's what those are there for, to protect subs like you described on those types of projects. So that's another way that I would suggest is to explore the idea of a lien.
Okay, I mean, can we lien King County? Because that's who contracted, the prime contractor who contracted us. And we did, like, I've asked this question to both members of King County and the prime contractor who was responsible for this HMA compaction statistical evaluation, and they refused to answer this question. And what they're trying to do is get us to have to go back, rip up the work that we did, do it all over again, and they want us to pay for it.
Right.
And we're like, hold on, we're not going to pay for it when we're not the reason why the job failed. The job failed because the statistical evaluator didn't show up.
Right.
And we were told
right.
to continue, and then they opened the road back up. So it just feels like because we're a small business, we're being taken advantage of.
It does.
Angelica, can I just add just a little bit? I think another thing that you could do, are you SCS certified?
You know what? See, my mom is the president of the company, and PTAC has been telling us, get this certification. And I've been telling her, Mom, you got to get this certification. And she like won't do it. So is there something that could really help us because maybe if I'm like, hey, Mom, if we did this, then we'd have a better shot at getting our money sooner rather than later. Is that what you're kind of trying to say?
Yeah, I mean, what I could do, I could contact small business folks at King County, because you guys are small business.
Yes,
and
we are.
Another thing that we could do, we talk with the diversity or small business group at King County and help you guys. They will contact the prime contractor. It's just kind of like put them in the hot seat,
Yes,
just make them get exposed. I'll be happy to do that and doing it offline. Another thing I've done in the past, some of our bonding clients, but I will try to figure it out with the funding. We did actually pay a lawyer just to help with our client to write a letter to the prime contractor, just to kind of like give them a little bit more, it's not bluffing, but just kind of let them know that we're taking it seriously. But I think at the end of the day, I think Pete had a great point talking to the project owner. I think it's all about who do you have relationship with, but we could help you with that. I mean, especially I will be happy to check if the contract has a US DOT funding in it. That probably give us more power to go ahead and then, talk to them.
Yeah, anything we can do to get help would be amazing. We even have written like confirmation from Earl Key at WashDOT, because the person who was in charge of like evaluating the job was working for WashDOT, and I'm a part of the advisory board there. And so Earl Key wrote an email that stated the job did not pass because of the HMA compaction statistical evaluation not passing. So like, I feel like we have all of the information and evidence on our side, but for some reason King County and the prime contractor are trying to peg us for the blame and the cost of the.
I'll get you connected with Sandy Hang's group, and also probably with the King County DOT folks. We'll talk offline.
Perfect. So what's the best way for me to get your contact information, or should I just look in the chat?
Yeah, I'm going to email, write my email in the chat. Thanks.
Oh my gosh, thank you.
Yeah, that's great. Yeah, I definitely agree that the next step would be legal action, or just kind of a hint that legal action is coming. A claim or a letter like you described, just to up the ante a little bit. You got to do something to grab their attention. That's great advice.
Okay, all right. I mean, it's just unfortunate that a small business is trying to be blamed for something that wasn't our fault at the end of the day. And I really want to just solve it and move on. But thank you.
Do you know who's the prime contractor again?
Yeah, it's James W. Fowler. And we've worked with them, and like we really do enjoy working with them, and we're so grateful for the opportunity. But this particular instance does feel really strange to me, and the fact that I keep asking who was responsible for this test and no one answers. Like they'll answer all these other questions except for that one. So I'm like, I feel like they're kind of like trying to skip around it because maybe one of them is at fault and they don't want to take the blame. But I'm like, come on, we're professionals here. Let's stop acting like children.
Sure. We'll talk. Okay. Thank you, Angelica.
Thank you.
One other thing that you mentioned there that I want to point out really quickly, you mentioned WashDOT and the various departments of transportation sometimes will ask for contractors to provide an indirect cost associated with their projects, and for that indirect cost rate to be audited. If you don't know what I'm talking about, then this doesn't apply to you, and don't worry about it. But
I think you.
We've got a group of. Oh, just a second. Can you hear me?
Yeah, I think you just cut out for like a brief moment.
There's a classic dead spot on my journey from. But if you're hearing about indirect cost rates and needing an audit for indirect cost rates, that's another kind of nuanced piece that's associated with a lot of Department of Transportation work. And we've got a group at my firm that's really knowledgeable about that piece of the DOT's regulations, and can be really helpful. So if those questions come up, feel free to reach out and I'll get you connected with people that can give you some answers.
Thank you. Will your information be included in the chat, or what's the best way to get a hold of you?
It's in the slide. It's in the last slide of my materials. And definitely Jessica and the organizers here can pass along my my contact information, email, phone number, etc.
Perfect. Thank you so much. I appreciate your help deeply.
You're welcome. Yeah. Okay. Anything else?
I think we're good to go. So we'd like to thank Pete Miller for coming and giving us a crash course in accounting. It's like your graduate studies at the local university, all in 1 hour. So thank you so much, and we'll be in touch with you, Pete. We appreciate you being here. And with that, I think we'll, if there's any other questions or any other closing remarks that need to be made, Jessica, Lily?
I know that a couple people have asked, but I just want to let people know that all the session of this workshop is being recorded. So along with our regular email with training materials, we are also going to include the access, if not the link, for the recordings for all the sessions for you to enjoy at a later time.
Thank you. Thank you. Thank you.
Please don't hesitate to contact us, okay? If you, let's say, have something, burning questions, some follow-up, stuff like Angelica that we could help, just let us know, okay? We're here to help you. Thank you.
Thanks. We look forward to the continuance of our construction track on these classes. So we'll be here next Tuesday. Same time, same place, and we look forward to seeing you then. So with that, we'll call it a day, and we'll see you next time.
Thanks, everybody.
Thank you for a great presentation.
Thank you.
Yeah.
Bye-bye.